Okay, so this is what we are looking at when we are going to start our Starlight strategy. First of all, I'm going to go over all the indicators on the screen. Then I'm going to go over, once we've talked about each indicator, the entry rules, and then we'll be looking at your stop losses and your take profit. This might be split up into multiple videos, but I'm going to go through them here. If I think we've hit enough information, I'll just stop it and then we can send another video towards the end. So, what do we have on the screen here today? Well, it's four indicators, right? Super trend, we have the EMA, we have the pivot points standard, and we have the awesome oscillator. Apologies if that's not spelt right. But this is what we've got. Now, we are using these indicators. All of them are completely free because if you haven't figured out already, this is a mechanical strategy. This is a mechanical strategy, which means there are entry rules 1, 2, 3, 4, in this case, 4 of them, just like there are 4 indicators based on each rule is based on each indicator, right? Now, this means that when we backtest, we have consistency. The problem with a non-mechanical strategy, let's call it a human bias strategy, is this. If you're using things like fib retracement tools, whether you're using candlestick patterns, if you are drawing out even support and resistance lines by yourself, you are going to run into human bias. You cannot be consistent. For example, right? If you want to figure out if something works in any field, you're going to go and test it out, just like we're back testing here. If you're looking for a new procedure to maybe fix, I don't know, something in a heart transplant with a surgeon, you're going to go over and you're going to try that on a dummy, right? There's things that you are going to be doing. If you think there is a better way to calculate a certain equation, you are going to go and test that out. You are not just going to go into the markets and go, okay, here we are, because you don't have any data to prove that you can do it. It's the exact same if you're starting a business and you want a loan. You don't just go up to a bank and say, hey, I've got absolutely no consistency and no data to show you that this thing works. That's why the human bias strategies suck. Because, for example, if I am using a fib retracement tool, which is absolutely nothing wrong with, and I draw it out like this because my teacher told me that's how we draw it out, great, you can totally do that. But what if your friend is taught by a different teacher and he actually tells you to draw it out from here to here? Do you see that the 0.382 are in completely different spots, right? And with this, because there is no universal law or way to draw a fib retracement tool, just like there is no universal way to draw support and resistance, right? Maybe I draw it here. Maybe some people would draw it here. Who knows? Because there is no consistent universal way, when you go and backtest this in the market to say, hey, did it work last year? Did it work the year before? Did it work the year before that? You cannot get an accurate picture because you might change your mind. You might draw it slightly differently. It might not always be in the same place. You might be seeing different trends and then halfway through switch it without even realizing it. That is a problem. I've had an argument or more discussions with people. If you check out my YouTube channel, you will see this, where people presume, which is very silly, it's very silly, that, hey, the majority of people are going to draw it like me. That's what people say. Alex, even though you've drawn support here, obviously the vast majority of people are going to draw it there. You do not know that. There are millions of people that trade, millions of people that trade. And to say, hey, the vast majority of people are going to draw it like this, you're deluding yourself. You actually have no idea. There is no scientific basis on which you can say that is the truth. Because you don't know if there is a student or a teacher out there called Jack who's really big on YouTube and he actually teaches 100,000 people to put it here. It's the same with the Fibonacci retracement tool. It's the same with candlestick patterns. All of these things, there is no universal way to draw, measure any of these things out. So when you go and backtest, you cannot get an accurate representation. Whereas if you stick to things like indicators, for example, or solid rules or universal laws to do your strategy that are very strict, they are mechanical in nature, you are going to get accurate backtesting. It is going to be consistent because you do the same thing over and over and over and over again with little to absolutely no variation. And if you do mechanical, there should be no variation because you've got rules. That means when you go to the bank and you say, hey, I want a business loan, and you show them the data and you say, this is what's happened the last 3 years every time a cookie store opens or whatever it is, well, hey, you've got something that is going to work and you're probably going to get that loan. Or in this case, you're going to have a strategy that you know can work, and no one can go to you if they backtest the exact same way that you do, which they should, and say your strategy doesn't work. No one can backtest my strategy and says that doesn't work. That's why we do it mechanical. So even though we've got some super simple and easy to understand indicators up here, nothing too flash, the whole point is to overcome your human bias, get your mechanical strategy so you can get consistent results in the past and therefore in the future as well. Awesome. Now we've got that out of the way, let's continue on to what these things are. If I just take this off. So the first thing is super trend. Super trend. Now, as you can see here, we've got some clouds. If the super trend is red, guess what? It's bearish. If the super trend is green, guess what? It's bullish. That's all it is. That's all it's telling you. Red and green and red and green and red and green. Is it bullish or bearish? It's just telling you the trend. Again, even though this is so simple, the majority of you that watch this will be able to tell that, hey, guess what? This right here, or this market here is clearly going down. We could have 100 lessons together, 100, and I might think that the trend changes here, but you might think that it changes over here, right? That's a possibility because now it's a human bias thing. We do not have a universal way to tell when the trend changes. So I might hop into a sell and win, and you might miss that sell altogether. How is that going to work for you long term? It is not. So that's what the super trend is here for. Super simple, super easy to understand. Then we've also got the EMA, or the moving average exponential. Don't ask me why it's the moving average exponential on here, yet it isn't. It's moving average exponential on here, yet it is the EMA. Because if I click on this, guess what? It says EMA. I don't know why TradingView has done that when it's moving average exponential on the indicators bit. Great way to confuse new traders, TradingView. Great way. But it is called the EMA, estimated or exponential moving average. You can see its default. I do not have to change any of the settings. Right? This is showing us the average price of the market. It's showing us the average price of the market. You can see when we're above this blue line, that's now come on my screen, right? Take the EMA off, no blue line. Turn it on, here it is. It's good because it uses it as support and also uses it as resistance. So this is going to be really good for showing potential reversals. And when we're on a trade or in a trade, we might want to stay in. All right. If it crosses over, we might want to hop out. So it's good for staying in trades and hopping in trades. That's what we're looking for here. Now, we have the pivot point standard as the third one. Pivot points standard right here. So this one, these golden lines, it's a fantastic indicator. I managed to talk to this French trader a while ago. To give you a little bit of background information on him, he was selling his strategy for about 50,000 euros back in the day, and he had his own hedge fund private, and it was closed off to the public because he was doing so well. I managed to talk to him, listen to him, and say, hey, I know you're not going to give me, your strategy free. I don't have anywhere near that money, but, please just give me any advice, even if it's throwaway advice. I'd appreciate it so much. I really want to become a trader. He just said, use this indicator. When he brought it and I put it on my screen, it was fantastic. It changed my life. So what you have are P's and S's and R's. R1 is resistance. P is pivot, and S1 is support. Now, if you were to break through R1, there's R2, which just means if you break through your resistance, you're more likely to find resistance up here. Then you have S2, which is just the same. If you break support, you're most likely to find support here. All it does is at the start of each week, for me, it's Monday at 7 a.m., they appear. It populates itself. It uses a mathematical equation using current price action and what happened in the upcoming weeks to say to me, hey Alex, as soon as this 7 a.m. on Monday comes around, this is where I think resistance is going to be. This is pivot, can be used as either support or resistance. That's where I think it's going to be, and that's where I think support is going to be through here. And you can see, if we go up and have a look at this, that at least somewhat, it's quite accurate, right? That's what we're looking at through here. So the pivot point standard is drawing out our support and resistance lines for us, because if you can remember, support and resistance lines, as we talked about, with human bias. So we've overcome that. Now we have through here support and resistance lines that are drawn out and can be consistent. Now, a heads up, I teach support and resistance differently to most people. Now, again, support, for those of you that don't know, it's like your family. The market comes and hits here, you're expecting a boost up. If it's resistance, it's like your boss. You're going, hey, can I have a paycheck, rise? No, you can't, you go back down. That's what it is. It's ceiling through here and floor through here. You hit the floor and you bounce off the floor, great. Get knocked down, you get back up again. This one is just getting knocked down, right? Like, that's what it is. You're soaring, hit your ceiling and come back down. You've flown too close to the sun, right? That's what it is. So this just draws it out for us. Now, as I said, I draw support and resistance lines out differently. In fact, my whole thing is completely different to most people. But my mentor taught me about support and resistance, said, Alex, it doesn't really exist. What is support and resistance? What is support and resistance? Well, it's this. They are areas of reactivity. If you're explaining what's happening at each of these lines to an alien, you would say once it gets this line, a reaction happens. It reacts with the line and movement occurs from there. It reacts with the line, movement, reacts with the line, reacts with the line, movement. That's all it is. It's areas of reactivity. And we can see here, even though this is a resistance line, it's used as resistance here. It's used as support multiple times. It's used as support or resistance again here. And then finally used as support one more time before going off. So if you looked at this, and most traders say, oh, well, once resistance lines have been broken, like it did through here, it's a useless line. No, it's not. It's doing its job. That is what it is doing. It is doing its job. It is being a area of reactivity. If you just said, oh, it's broken, so therefore I'm not going to look at this, you missed out on any opportunities here, an opportunity for a sell here, and an opportunity for a buy here, just because you think that this is a resistance line. No, think of it in terms of this. It is an area of reactivity. Apologies for my phone going off. So now that we've got that out of the way, we know what support and resistance is. What we now need to do is understand that these areas of reactivity are really good areas for entry. So now that we've confirmed that this is an area of reactivity, do we not think it's a great area to hop into? See, most people confuse what is the most important thing about building a strategy. It is, of course, where to hop in. If you hop into the right area, well, guess what? You are doing 80% of the work. If you know a reaction is going to come from this area and something is going to happen, well, great, we can hop in there. Rather than hopping into a point in the market where you don't know if something's going to happen. Would you rather go to a concert where you know someone is actually going to play something? You don't know what band, but someone is going to come up and someone's going to play something. Or go, well, I'm just going to hop into a random spot in the market and hope that something happens there. No, because here is our area of reactivity, and that is where we are going to enter. So with that being said, now we're going to move on to the awesome oscillator, which is here. I just type in AO, awesome oscillator. Now, do not worry about anything on this side here. The numbers, there's no causation or correlation to these numbers to this. It does not matter, so you don't need to worry. All you need to worry about is this is a momentum indicator. Momentum. So we have green bars and red bars. When there's red bars, guess what? The momentum is with the sellers. When there's green bars, the momentum is with the buyers, right? So if we're going for a sell, we always want the momentum to be red. And we're going for buys, we always want the momentum to be green. That should make sense. So just to reiterate this, Supertrend tells you the trend. EMA is going to be useful for reversals and staying into trades. Pivot point standards are good for entries because they're reactivity zones. They're showing you where they are. And the awesome oscillator shows you the momentum of the markets, right? And you can see through here, plenty of areas where the markets interact with these zones and we get large moves from them through here and here, even through here, right? So that is what we're looking for. So those are all the indicators that we use when we are hopping into the market. So this is video 1 here. If you want to basically message me any questions, if you don't understand anything, then just stop, because the second part of this video, which is going to be the entry rules, just won't really make sense to you. Send me an email, send me a Discord message, send me a message on Fiverr, whatever it is, wherever you are talking to me currently, go through there and I will speak to you in the next one. All right, guys.